liquidity risk. So this video deals with some of the terms associated with liquidity risk. First of all, let's see what do you mean by liquidity risk. Liquidity risk deals with two variables. One is cash, another one is timely basis. Okay, so that means when you need to pay off liability, you require cash, and you require cash when you have to pay off liability. That means timely basis. Okay, so making sure that cash is available on timely basis to pay off liquidity is needed. If not, then you will face liquidity risk. Okay, so this is what it deals with. Some of the terms associated with this liquidity risk are like first one, asset and liability management. Asset and liability management. Okay, what it means is making sure that there is flow of cash. Okay, asset here refers to cash to manage, so cash inflow to manage cash outflow, or liability. This is liability. Okay, so basically asset liability management refers to making sure that there is enough cash to pay off the liability. If not, then it leads to asset and liability mismanagement. Asset and liability mismanagement. Okay, so now what is this assets and liability mismanagement? As in what? Say for example, like this company DHFL faced bankruptcy issues few years back because of asset liability mismanagement. Now the way it was functioning is it was sourcing funds. This is an NBFC, right? Non-banking financial company. So basically it used to give loans, like real estate and all. So it used to source funds from short-term financing. Okay, it used to source funds from short-term financing. So that means it is supposed to repay quickly as well, right? On short-term basis. But however, it was lending on long-term basis. Lending on long-term basis. So that means you are going to get cash very late. Okay, full cash you are going to get very late, whereas here you have to pay the principal amount very quickly, whereas the principal amount that you are going to get is later. So there is a mismatch between your assets and liabilities. Okay, so your liability is appearing very quickly and your assets are going to come back very late. So that led to asset liability mismanagement, and then this company finally had to file for bankruptcy. So basically assets and liability management makes it sure that there is enough cash or more cash to pay off your liability when the liability is due. That is asset liability management. Okay, the second one is maturity ladders. Maturity ladders. So maturity ladders as in ladder. So ladder as in over here it refers to like investing in various fixed income securities with various maturities. Investing in fixed income securities with various maturities. Investing in fixed income securities with various maturities. So because it will be invested in various maturities, then the cash inflow will keep happening. Okay, because at regular interval this fixed income securities will get matured and you will keep getting cash flow. So this way you will reduce liquidity risk. Okay, so this is maturity ladders. Okay, so this is one way to manage your liquidity risk. Third one is actual and contractual cash receipts. Okay, actual and contractual cash receipts. So that means actual cash. So certain cash flows will be based on the actual movement of the market. Okay, so cash flow or cash inflow rather is based on the actual movement of the market, actual movement of the market. Okay, so this is, so that means this is not so very, trustworthy, or you cannot completely rely on this actual cash receipts, right? Because it depends upon the movement of the market. Contractual means fixed cash flows, so which is not dependent on the market. Fixed cash flows. Okay, fixed cash flows which is not dependent on the market. So your contractual cash receipts should be such that you are able to pay off your liquidity on time. Okay, so actual you cannot rely much. Okay, so the combination should be in such a way that at least the contractual cash flow should be able to fulfill uh, the uh, the liability. Okay, that is actual and contractual cash receipts. Okay, then the next one, asset liquidity risk. Asset liquidity risk as in how quickly you are able to sell off your assets. Are you able to sell off your assets on time, quickly or not? For example, real estate you cannot sell off very quickly, so real estate has liquidity risk. Okay, but whereas if you want to sell off your marketable securities, you may be able to sell off very easily. Okay, so that's what asset liquidity risk is all about. Like if you are able to sell off your assets on time or not. Marketable securities, less liquidity risk, and something like real estate or plant machinery, high liquidity risk. Okay, yeah. So you have to make sure that you invest in marketable securities, so that when you have to pay off the liquidities, you are able to pull cash. Okay, then funding liquidity risk. Funding liquidity risk as in how are you going to source funds to manage liquidity risk. Okay, that is funding liquidity risk. So if you are facing difficulty to source funds, or if sourcing funds is expensive, let's say high rate of interest is involved, if sourcing funds are expensive, then it is funding liquidity risk. Okay, then it is funding liquidity risk. So two things here. um, one is if you are finding it difficult to source funds itself, or you are funding it but expensively, then it is called funding liquidity risk. Okay, then fund liquidity risk. Fund liquidity risk. Okay, fund liquidity risk as in this is pertaining to something like mutual funds, hedge funds now, which is facing let's say severe redemptions. So when huge redemption takes place, probably the fund might find it difficult to repay, and uh, they might uh, uh, freeze the redemptions. Okay, they might freeze the redemption. So when they freeze redemptions of units, when they freeze redemptions of units, it is called gating. Okay, so when they do this gating or freezing redemption of units, this can further aggravate the situations, and further this can lead to more redemptions. Okay, so such situation is called fund liquidity risk. Okay, when the fund is unable to pay off the redemptions of units. Okay, so these are some of the terms associated with liquidity risk. Now Basel 3 have also come up with Basel 3 have also come up with a couple of terminologies. One is liquidity coverage ratio. and net stable funding ratios. Okay, now liquidity coverage ratio refers to high quality, okay, uh, high quality liquid assets, shortly called as HQLA, high quality liquid assets. Uh, so refers to having high quality liquid assets to pay off your short term obligations. Okay, short term obligations. So what is this high quality liquid assets? It can be something like cash, uh, then uh, central bank reserves that you keep it with the central bank. It is central bank reserves, or it can be government securities as well. GSEC, government securities. Okay, so this is liquidity coverage ratio. Then net stable funding ratio, as in net stable funding ratio. So net stable funding ratio, as in you can think like this: um, available amount of stable funding. That means cash inflow. Okay, stable cash inflow. So this refers to stable cash inflow. Okay, for required amount of stable funding. Okay, so required is cash outflow. Okay, so yeah, and so liquidity coverage ratio, I forgot to tell you that liquidity coverage ratio, high quality liquid assets, as in this is done, this is a way to do stress testing as well. Okay, stress testing as well. So stress testing, as in, say for example, on 30-day basis, worst to worst case, suddenly if there is a huge requirement to pay off the liability, then how much cash or how much liquid assets do you possess, and how much cash inflow you can create to pay off. So this is a way to do stress testing as well. Okay, so stress testing, as in this case, it refers to if there is a sudden requirement for you to pay off the liability, can you still manage? So that's the stress testing happening through this liquidity coverage ratio here. Okay, fine. Then now, how do you measure this liquidity risk? So measuring liquidity risk, measuring liquidity risk. So how do you measure liquidity risk? One is through bid offer spread. Okay, so bid offer spread, as in the difference between bid and offer price. Bid means the price at which you want to buy, buying. Bid refers to buying price, offer refers to selling price. Buying price and selling price. If the buying price and selling price has a huge gap, that shows liquidity risk. Ideally, in a liquid market where there is no liquidity risk, where in a highly liquid market, okay, in a highly liquid market, bid and offer spread will be very less. Spread will be very less. Okay, Whereas if there is liquidity risk, it will be high. Okay. Reason being, there will be less participants, and when there are less participants, the spread will become higher. Okay. So when I say participants, I am referring to market debt. Market debt. So market debt, as in how deep is the market, how many participants are there. So how deep is the market, and or in other words, how many participants are there in the market. How many participants means buyer seller. How many participants are there in the market to buy and sell? How many participants are there in the market to buy and sell? Okay, that is market debt. Okay, market debt. Okay. So if more participants are there, more buying and selling will happen, and when more buying and selling is happening, the bid offer spread will come down. Okay. Then some other uh, you know some other uh, terms associated with measuring liquidity risk is, one is bid offer spread we have discussed, then market depth, then similarly immediacy. That means how quickly. Immediacy means it is coming out of the word immediately. So how quickly you can trade and you can sell off your assets. Okay, that is immediacy. Okay. So whether it is taking higher time or lower time. Okay, so this deals with how much time it requires to sell off, how much time it requires to sell off the assets and generate cash. Okay, then next one is resilience. Okay, so resilience, as in if the assets price is falling down for some reason, how quickly it is able to come back. That is called resilience. Okay, so if the assets price falls down for some reason, if the assets price falls down for some reason, okay, can it bounce back quickly? That is called resilience. Quickly, that means basically assets with strong fundamentals should be able to bounce back. If it doesn't have strong fundamentals, then it will not be able to bounce back, right? So these are some of the terms associated with measuring. Okay. Yeah. Fine, otherwise this is it. Thank you so much for watching this video. Thanks a lot.